Well, thank you very much, ladies and gentlemen. It's a pleasure for me to be in Dublin today to address insurance specialists from here in Ireland and I understand from all over the European Union. I'd like to thank the EIF for their very kind invitation to do so. It's a particular pleasure and a little bit nostalgic, if I'm honest, to speak at this venue in Croke Park. I was born about a kilometre and a half away from this stadium, and I went, as has been said, to school at O'Connell's, just around the corner. So I'm very impressed by the work of the students. I have to be honest, I had absolutely no interest in insurance when I was in O'Connell's, but there you are. I know this area very well. As a schoolboy, I was a visitor to this, what was then a much less spectacular stadium, in support of my school football team and, of course, the Dubs. Unfortunately, my memories of All Ireland in the 1970s are not quite as happy as those more recently. I never dreamed of 5 All Irelands in a row, and more importantly, I never dreamed that I would be sitting here or standing here giving a speech on EU policies on the insurance sector. But as you all know, insurance can be exciting as well. Now, in my remarks today, I'd like to focus on a set of issues that are relevant to the insurance industry from an EU perspective. And more specifically, these issues relate to 3 things. The forthcoming review of the Solvency II Directive, where we are and what we're looking at, so I will tell you a little bit about that. The completion of a single market in insurance services in the context of the Capital Markets Union project. And here, notably, I want to talk a little bit about home host issues and maybe a short word on the PEP. And lastly, relevant developments at the wider international level, in particular work at the IIS and the implementation of the EUUS covered agreement. And if there's time, I will say just a very few words, and I mean a very few words, on Brexit. So let me start with a review of the Solvency II Directive. These are challenging times for the EU financial system as a whole, and the insurance sector is no exception. The low interest rate environment is putting traditional insurance models under pressure. Digitalization and climate change, while opening up new market opportunities, also present formidable challenges. And geopolitical developments, some of them very close to home, imply big shifts in the insurance structures within the EU. And all of these challenges are appearing against the background of a still relatively new insurance prudential framework in the EU. This, of course, is the Solvency II Directive, which entered into application at the start of 2016. We now have almost 4 years of experience of Solvency II implementation, and we in the Commission at least are pleased with the smooth nature of the introduction and the subsequent stability of the new prudential regime. I should note here that IOPA, the Insurance and Occupational Pensions Authority, take a lot of credit for this achievement. But Solvency II is already a regime under evaluation and review. Among the changes already introduced are reductions in risk charges relating to certain asset categories. These adjustments were designed to remove barriers to investment in assets that are of long-term value to the economy, such as equities, infrastructure, and high-quality securitization. They were fully in line with the Commission's policy to facilitate economic growth and job creation across the EU. Earlier this year, we completed the first phase of review of Solvency II. This phase concerned the detailed implementing rules, what in our jargon are called delegated acts. But as you all know, a more fundamental review of Solvency II, the big show, is coming by the end of 2020. Now, the 2020 review should be seen in the context of other Commission policy initiatives, such as the Capital Markets Union, sustainable finance, and digital finance. Therefore, it will be more than just a technical review. It will be one of the more important financial services files for the incoming Commission. Now, IOPA have already been working for some time on its input to the 2020 review, and this is based on a call for advice from the Commission. This call for advice covered 19 different areas of Solvency II. IOPA's draft advice will be published for public consultation in just a few days, and the consultation will be open until mid-December. I've been asked to ask you, but I'm sure I can rely on you, as always, not to hesitate in sharing your views with IOPA on their consultation. If any past experience anything to go by, I don't even need to say that. If you read IOPA's draft advice, you will see that it includes some advice which the Commission did not request, particularly in the macroprudential area. That's fine. Even unsolicited advice is welcome. And we'll examine those parts as carefully as we examine all else. Now, before finalizing its advice, IOPA will also conduct a holistic impact assessment. So this assessment will evaluate how all the changes proposed will interact with each other, and not just the impact of each proposed change individually. A key element of the review will be an evaluation of the long-term guarantee measure. In this respect, the Commission has asked IOPA for input on the matching adjustment, on the volatility adjustment, and on transitional measures and extrapolation methods. All that sounds rather technical. It sounds technical to me too, so don't worry. But the experts among you all know very well that this selection of measures impact very significantly on the bottom line of the solvency capital requirement for insurers. The 2020 review will also cover many other technical aspects. These include the risk margin, the proportionality aspects of the directive, and in particular, whether exclusion thresholds for smaller insurers should be higher and the reporting rules lightened. One final item of the 2020 review, which I'd like to draw your attention to, is group supervision. Following its 2018 report on the functioning of colleges, the Commission recently adopted a report on group supervision and the experiences under Solvency II. This report was based on extensive IOPA input, so group supervision was one of the issues we asked, of the 19 we asked in our call for advice. The report covers such areas as subgroup supervision and group internal models. Meanwhile, the call for advice asks IOPA to reflect on group solvency calculation issues, group minimum consolidated capital requirements, intragroup transactions, and third country issues, and any governance gaps regarding groups. So in short, the 2020 review of the Solvency Directive will examine whether the prudential framework appropriately reflects the long-term nature of the insurance business, and whether the framework adequately allows insurers to invest countercyclically and on a sustainable basis. And this reference to sustainable basis is rather convenient because it allows me to take a minor deviation from my remarks to comment on sustainable finance. I simply can't emphasize enough the importance of the Sustainable Finance Initiative for the Commission. Indeed, the Sustainable Finance Initiative will now form an integral part of a much bigger project, the so-called New Green Deal, which is one of the signature policies of the incoming Commission. The Commission services are currently working on integrating environmental, social, and governance considerations into the implementing rules of our various pieces of financial legislation, including Solvency II. And this is because the costs of transitioning the EU economy to carbon neutrality are vast, and they cannot be met only by the public sector. They need a reorientation of private financial flows. With more than 10 trillion euros under management, we believe the insurance sector has a huge potential to contribute to this effort. Climate change is arguably the biggest of all the challenges facing us today, and the insurance sector is exceptionally well placed to play a central role in the fight against climate change, both through its investment activity and its underwriting activity. And in that context, I welcome the opinion from IOPA on this subject that we received just in the last couple of days. So I'll now turn to the second topic of my remarks, which is completing the single market for insurance services. The future of the single market for insurance services is another key focus of the review of the Solvency II Directive. And this is particularly so for the cross-border provision of services without establishment of a branch or subsidiary. Free provision of cross-border services with supervision by the home supervisor is a linchpin of the single market for services. But what if the cross-border insurer has zero activity in the home member state? And what if that home member state has only limited supervisory resources? Now, I'm aware that Ireland has not always had happy experience of cross-border insurance. As a host member state, Ireland has had to cope with failures of insurance based in other member states, but with many customers here in Ireland. We all know the names, I would not mention them again. Ireland found solutions in those instances, albeit after some litigation, but there were delays in payment of compensation to victims of motor accidents, which is hardly acceptable. This calls for a solution to be found at the EU level, not leaving member states to take care of it for themselves. So what is the response of the EU to this issue? I'd mention three specific responses. First, in the area of motor insurance specifically, which is often concerned by cross-border aspects, we have a proposal currently under discussion by the European Parliament and the Council for a revision of the EU Motor Insurance Directive. This proposal implies a completely new insolvency mechanism to ensure rapid repayment of victims of motor accidents in case of insurer insolvency, especially in a cross-border context. An entity in the country of residence of the victim would first pay full compensation and then claim a refund from the home member state of the failed insurer. It would be a two-step process, and there could still be litigation if the home member state, of course, does not refund rapidly. Importantly, however, the victim, the injured citizen, would not have to wait for compensation. And the well-being of the citizen has to be our first concern here, and I very much hope that this proposal can be adopted quickly. Second, as part of our review of the Solvency II Directive itself, we have asked IOPA to collect data and reflect on possible improvements to the framework for cross-border provision of insurance services. But here I need to be clear about one thing. We cannot simply ban the provision of cross-border services if an insurer has zero activity in the home member state. That would not be compatible with the treaty provisions on the free movement of capital. So we need to think of other ways to frame cross-border provision of insurance services. Clearly, IOPA has a major role to play here, and it's trying hard to set up collaboration platforms for home and host supervisors in case of cross-border insurers. Such platforms recently received a legal basis in the reform of the regulations of the European supervisory authorities, and that's a welcome step. As a third response, we are reflecting on the appropriateness of a possible legislative initiative on recovery and resolution of insurers. This recovery and resolution framework would be analogous to the so-called Bank Recovery and Resolution Directive for banks, but of course it would not be exactly the same. Such an initiative might include a more general evolution of insurance guarantee schemes going beyond what's in our limited proposal on motor insurance. But no decision has been taken on this yet. It will be something for the new Commission to decide, and of course the devil would be in the detail of any such proposal. It would have to be fully prepared with public consultation and impact assessment, and of course fully in accordance with better regulation principles. In discussing the completion of the single market for insurance services, I would also draw your attention to recent work in the field of pensions. This, of course, is of particular concern to insurers, many of whom are pension providers. An important Commission initiative in the context of CMU, which recently entered into law, is a legal framework for a PEP, that is a pan-European personal pension product. Try saying that after a few pints. This is envisaged as a complement to personal pensions already on the market in member states by facilitating both cross-border portability and cross-border sales. A core of product features for the PEP will be harmonized at European level, while the others will be left to national law. Some of the detailed rules for PEPs are now being worked out, and they can actually be launched 1 year after those detailed rules are in place. And that's expected about 1 year from now. So within 2 years, I very much hope to see the first PEPs launched on the market. And before leaving the single market topic, just a word on the revised EU directive on occupational pensions, known as IOPS, again in our jargon. These have also recently entered into law in member states. Now, I know that Ireland was one of the member states which were a little reticent about further legislation, at least European legislation, in this area. But the legislation we put in place has to be seen in the CMU context. It's about encouraging and facilitating the development of a demand side in a capital market union via funded pension schemes across the EU. We must bear in mind that in many member states, unlike Ireland, pension provision is essentially within the social security system, so-called Pillar 1 pensions. That arrangement is not sustainable in the longer term. So while only 7 member states currently have IOPS, we can hope that that number will rise in the future. Let me now turn to my third and last topic, which is international issues and the evolution of developments relevant for the insurance sector at the global level. And here I want to focus on 2 things. Discussions that are ongoing in the IIS on the so-called international capital standard for internationally active insurance groups and the EUUS covered agreement. The IIS has committed to reach agreement this year on an international capital standard, ICS2, for a confidential monitoring period of 5 years. This, of course, means that ICS2 will not be a binding standard for the Solvency 2020 review. While a number of key features of the ICS2 are still open, I believe that it will be possible to find an agreement in time for the IIS annual meeting in Abu Dhabi next month. But here I want to sound a word of caution. The IIS took a decision in Kuala Lumpur, they get around these people, a couple of years ago to defer decisions on certain important ICS-related subjects until the end of the monitoring period. These included some elements of the ICS itself, so the internal models and the gap plus valuation. They also included one subject outside the ICS, and that's an aggregation approach to group solvency and group capital that's being developed by the United States. Trying to bring forward any of these decisions to this year could put at risk the key decisions on ICS2 itself by taking up precious time and precious energy in the discussions. And that's why the Kuala Lumpur decision established a staged decision-making process, and we think that was a wise choice. Let me also say that participation by international insurance groups in the monitoring period will be essential for the long-term success of ICS. So I encourage all such groups that are here today to commit to participate, despite, of course, the obvious reporting burden that's involved. Another important development at international level is the implementation of the EUUS covered agreement on group supervision and reinsurance. Here I was very pleased to see the US National Association of Insurance Commissioners, the NAIC, adopt a revised model law in June. The revised law incorporates the terms of the agreement, and needless to say, the development of a group capital assessment in the United States is an important step that we are closely monitoring. The EU's own implementation deadline for the covered agreement fell due last month, and we have been working very closely with all the member states to ensure that they have all of their practices in line. I think I do still have time to say a few words about Brexit, but they'll be very few. The fact is I can't say too much. I don't think anybody can, except to say that the EU has made a huge effort to prepare for every scenario. We are confident that any short-term storms on financial markets can be weathered and that there will be no serious disruption to the supply of insurance services. In case of a no-deal Brexit, the UK will immediately become a so-called third country on the same footing as other third countries around the world. Direct cross-border insurance to the EU will no longer be possible from the UK. Reinsurance, yes, but not primary insurance. Existing cross-border insurance contracts must be transferred to an entity in the EU. The vast majority of UK insurers have taken the necessary actions, such as creating EU branches and subsidiaries and transferring policies to them. Those few which have not yet done so now need, I think, to step up their efforts. I am very much aware that Ireland has far more UK insurers active on its territory than other member states. And for this reason, the burden on the Irish supervisor will increase. And I understand that it is recruiting more staff to handle the burden. I welcome that preparation, and I emphasize that the entire EU supervisory community, helped by IOPA, is working together to prepare. So, ladies and gentlemen, I think the next few years will continue to be a challenging time for the insurance sector and for the financial sector as a whole. The low interest rate environment and digitalization will mean, I think, profound changes in the insurance sector in the coming years. In the Commission, we will face those years under a new President and a new College of Commissioners. The President-elect has already presented to the European Parliament the 6 key priorities for her Commission. They are a European Green Deal, an economy that works for people, a Europe fit for the digital age, protecting our European way of life, a stronger Europe in the world, and a new push for European democracy. While the exact policy initiatives fulfilling those goals are still to be announced, I can see insurance playing a major role in most of them. Our programs for Capital Markets Union and sustainable finance will certainly continue to be rolled out, together with possible new initiatives which cannot be identified yet. So to conclude, I'm very optimistic that the Commission, together with international partners and with you as stakeholders, can confront all the upcoming challenges with great success. And thank you for your attention.
Very good. You can choose whichever you'd like. Which is your good side?
I'll sit on your right.
Okay. Yeah, that's fine. Lovely. Thank you. So thank you very much, John. I think that was superb. As I said to you off stage, we really do appreciate you taking the time to come with us, come speak to us today. I think it means a lot to get your perspective at what is a very busy time as you go into welcoming in a new commission. So thank you, first of all, for that. I suppose one of the themes which is going to dominate the actions and interactions that our sector will have with Europe over the coming 48 months or so is the 2020 review of Solvency II. And it's multifaceted. I think we heard this morning that you're into 900 to 1,000 pages. But I suppose one of the key questions I suppose we'd really like to get your sense on is, do you believe that the review will go in the direction of lower solvency requirements for insurers?
Well, I think it's not about deciding ex ante whether we go in the direction for lower or higher. I think we have to wait for the IOPA advice, which will come very soon. As you said, it will be, I think, only 800 pages now because they have reduced it.
Right.
And we'll have to study that, and we'll have to put it to consultation and see what people have to say about it. But I would point out that in the past, the Commission has not been averse to lowering capital requirements, even when the advice from IOPA was not to go so far. So you've seen that we have introduced tweaks in the system that favored infrastructure investment, for example. We've more recently introduced tweaks that favor equity, unlisted equity, that favor high-quality securitization. So, we have always asked IOPA to look into the sort of CMU-related aspects of Solvency II as well. So to sort of try to incorporate into their thinking, their function is clearly to protect the system stability-wise, but to try to incorporate the idea of sustainability and market financing into their thinking. So, let's see what the advice brings. We're not going into this exercise with a view to raising capital. We're not going into the exercise with a view to lowering capital. But we will see what the advice comes out. And as I said, our past record shows that if we think there's a need to rebalance, we can do it, and we do it.
Thanks, Sean. That's very enlightening. Could I maybe just move the line of questioning to look at the Motor Insurance Directive? And I think one of the things that has come to the fore in relation to MID has been the proposal for a home country-based model of insolvency protection and compensation. I was wondering about the rationale behind that proposal.
Well, the basic rationale is the treaty. We have to protect the free movement of capital. Okay, that's a founding principle. We're having a lot of discussions about founding principles at the moment, but that is one of them. So anything we do in that space has to be consistent with that. So therefore, we cannot simply ban the notion that an insurer can be in one member state and provide customers, even if all of its customers are provided with services outside that member state. The thing to do is to incentivize the home member state to take as much care of that insurer, even though perhaps its own exposure in first instance doesn't look so strong. So that's why we're looking at mechanisms which allow the cross-border provision, but ensure that the home country has the right incentives to supervise the home insurer, even if the bulk of that insurer's customers are abroad. And that's why we've made these changes in the Motor Insurance Directive, why we look a bit further in Solvency II. But we can't really break the fundamental principle that you are allowed to provide services across border in the EU.
I think as a predominantly exporting market such as Ireland is, I think we would always, that would be a cornerstone of our advocacy. In relation to, I suppose, picking up on the theme, we had the Motor Insurers Bureau of Ireland had their annual conference yesterday, and we had a discussion around the legality or otherwise of e-scooters. But just maybe the Commission's view in relation to a carve-out for light electrical vehicles, motorsports and private property, and the requirement for them to have MTPL in place. I don't know if there's something you can say to us about that, John.
Well, I mean, the proposal we have put forward does not propose any exemptions. That doesn't mean that, however, in the co-legislation process, the member states or the Parliament may decide to introduce such exemptions. But the proposal we put forward did not do that. If the co-legislators suggest that there should be carve-outs, we will certainly probably have to respond to that and take it into account. The one point I would make, however, is that already now member states can exempt any categories of vehicles from the insurance requirements, so long as they're covered in some way by an insurance guarantee scheme. So it's not a case, it's not so black and white, in fact, already today. We think that's enough, but if the co-legislators decide to do something different, of course, we'll have to take that into account. That's what we do.
I just have one question here from Dermot Curry in Milliman, and I hope I'm reading this right, Dermot, so if I get it wrong, you can let me know. In terms of cross-border business and potential barriers to cross-border business, there's probably a sense that volumes aren't really where they should be, and I think guarantee schemes are probably one element of that. Definitely sitting on the side of the equation that we do, we'd like to see more cross-border, more well-regulated and robust cross-border. Is there anything that you see the Commission can do to enable that?
I mean, I will say the insurance sector is a sector where we have worked less, I would say, over the last 10 years than either in banking space, because the crisis necessitated us to work a lot in banking space. And then, of course, we've had Capital Markets Union, which is the other side. And sometimes when I'm talking to Gabriel Bernardino, he thinks that, we're ignoring him. We're not ignoring him.
He's a hard man to ignore.
He's a hard man to ignore. But we are very anxious to develop a more cross-border supervision, more cross-border activity. We thought, to some extent, there was a scope for perhaps convergence more in the supervisory arrangements. So we wanted to put internal models, etc., with IOPA to give a sense of creating more of a single market. I think within the Capital Markets Union side, there's a big opportunity here because we have so far focused, I would not say uniquely, but predominantly on the supply side of that market. So trying to develop products and try to provide sellers. We have not so far, and we will have to do in the next round, look at the demand side. Now, I'm always very nervous when people put the United States as my metric, as my paradigm. It's not exactly the appropriate comparator for the EU, but it is clear that the US capital market benefits from having a rather developed demand side through the 401k. We need to think a little bit about ways that we can develop that. And I think in all of those areas, the insurance industry will have to then play a bigger part. So you'll be getting more attention in the future than you've got in the past.
Careful what you wish for. Maybe just one last question that we have here, and it's in relation to the international capital standards. Do you think the EU is going to implement those?
Well, I would say we wouldn't go into this exercise. I mean, first of all, we are committed, as my own vice president keeps saying over and over again, we are committed to a multilateral rules-based system. So if we're going into work on the ICS, it can only be that ex ante we would like to implement it. It will all depend what comes out. So we will have this 5-year monitoring period. If it works, then I think that is obviously the first step. Secondly, it will all depend what other people do. So is it going to be an international standard, or are others not going to implement it? We already have a standard in Solvency II, which is pretty good. Our only interest in moving to ICS will be to get global convergence. If it's not going to be there, then you may ask yourself why. And then lastly, I must say, in the end, it's not my choice whether we adopt it. This will be something that's adopted by the member states and the parliament. So we may propose it, but still it'll be up to the member states and the parliament to accept it.
John, listen, that's been marvellous, I think. We've greatly benefited from your insights. I think we're very grateful for you to take the time to come with us. It means quite a lot to us, and for taking everything that we've given you in terms of questioning and all the rest of it. So delegates, please, if you can show your appreciation for John Berrigan. Thank you very much, John.
Thank you.